about vantage point. So we analysis. A neural network process determines the most influence on a target market and then reflects the degree of that influence. A set of intermarket data. This market and predictive indicators often use typical prices, which is the average of the high, the low, and the close. The Vantage Point software by including all the action during the day and thinking of it in terms of typical prices of what might happen gives a little bit more reliable forecast of what the future holds, the short future holds for some of the prices. But we're going to look at some of the markets in a little bit more detail and see where are we today and kind of what point can we expect some things to happen and where we might be in a position where we are able to trade. The first market we're going to look at is the U.S. dollar index that you see on your screen there. This is a one-year chart. I probably need to explain, first of all, that in my analytical process and looking at a particular market, I like to look at a three-pronged approach. This is the one that was popularized by Lou Mendelson, who's president of Market Technologies. And those three approaches include fundamentals, and talked a lot about some of the fundamentals that are affecting them. That's in terms of the economic reports that you see and all the other kind of supply, demand, and related fundamentals definitely will guide the price, but we need something a little more than that to guide the price. So then we use technical analysis. When I say technical analysis, I'm talking about the more traditional technical analysis where you're looking at trend lines and highs and lows, support, resistance, that kind of thing. And then the third aspect of my analytical process is intermarket analysis. That's where, as I mentioned, with the Vantage Point software, where that comes in, where you can include the influence of the various markets that are most likely to affect a target market. So all of those things come together in an analytical program. It isn't just one thing that you're looking at. We're going to cut back our time frame here a little bit because we already can see, where the U.S. Dollar is going. It's been an uptrend. So we're going to cut this back a little bit to 6 months and talk a little bit about some of the indicators that we have on the charts. And we're going to add them, and we won't do it for all of these charts, but we'll kind of just discuss a little bit about what these indicators will show you if you want to apply them to any of the other markets that you might trade. The first is the predicted medium-term moving average. Very useful in terms of giving the overall market direction. The predicted moving average is that blue line that you see on the screen that has the angle of that. If it's headed up, obviously means uptrend. Headed down means downtrend. Pretty typical moving average types of stuff. The crossover situations are probably one of the keys in terms of showing when things are shifting, when things might change, when you might be able to say, okay, I need to jump on board a market right here because the whole scenario is changing. So we'll look at just a few of these types of things that I look at. This is kind of a standard chart. Some of the things that I would look at in terms of just where do I get some signals, where do I get some clues as to what potentially could happen in the future. First of all, just looking at the candles themselves, I think one of the important clues that you get from just looking at the chart is the doji. The doji is a candle that the open and the close are at roughly the same level. As you can see, we had a situation here on the top in the dollar where we had a doji there. We had another doji, similar doji right next to it. The key is where does that candle appear in the trend? We've seen, in this case particularly, we had a longer term trend. So at the upside of a trend, when you hit a doji, it indicates some uncertainty in markets, and it indicates a potential alert for a turn. You'll see that there are some other spots where we do have dojis. There are other dojis all the way along here. Then the key is what happens on that candle after the doji, after it appears. It may negate the doji. It may, just confirm the fact that we had some uncertainty, and now the market is ready to turn. So that's kind of from a traditional technical analysis standpoint, what we're looking at. A second thing that we're looking at from a traditional technical analysis standpoint is to keep in mind where some of these particular support and resistance points are. As you can see in the dollar, we had a situation right here where we had a low, and a low right in there. So we're talking in the area of about 85.50, kind of being a key point. And we've been sitting on that, went back to that, came back to it. Now, in this particular day, June 29th, we have bounced up from there. So is that the point at which we will find support, bounce back up, resume the dollar upward drive? That's the kind of thing that we need to look for and analyze as we move forward. So that's kind of one of the other traditional things. Of course, you also have, in addition to that, you have the some of the traditional types of things, like it's not on this chart that you can see here, but when you look at that high, if you remember that the previous highs going back a ways were somewhere around 89. So as the market approached there, you might expect some kind of a resistance against moving through there, and so you might expect something to turn back. Traditional technical analysis. The same type of thing is also true with some of the other things that you look at. You have your trend lines here. All these kinds of things are things to be aware of when you're looking at a particular chart. When it comes to the vantage point indicators, we're going to be looking at several of them. I mentioned the predicted moving average with that blue line there, which is compared with an actual moving average, which is that black line that you see on the screen there. We have a couple of other indicators at the bottom part of the screen, and where we apply those, the first one is this gray line right here. This is the predicted neural index. What it does is compare two 3-day moving averages, a predicted and actual moving averages, and forecast what the market will be, what the typical price, I should clarify, what the typical price will be in 2 days. If it indicates it will be up, the reading is 1, and if it indicates it is down, the reading will be 0. And, it's not a long-term indicator, but it's a good short-term indicator for a point in time when you're trying to get into a trade. You'd like to have that one be on your side if you possibly can. Simply because you want to get off to a good start as you can. Now, when we look at also the lines that you see here on the bottom, we have a couple of lines here that need a little explanation. The blue line and the green line are predicted differences. What they do is they show the difference rather between a predicted moving average and an actual moving average. Blue line is the medium-term moving average comparison. The green line is the longer-term moving average comparison. The important thing about these particular predicted difference lines is, number one, the angle. Generally, they are going to probably start to turn a little bit even before the predicted moving average, so it's an early alert type of a situation. Secondly, you're looking for the types of crossover situations where the medium term will cross over the green. What you have here is a indication of momentum changes as the market moves up real quickly, sharply here. All of a sudden, you had a spurt in the predicted difference line moving up, an indicator that moved up very strongly, but then it turned and crossed below the green line, so that was a signal that